All attendees are in listen-only mode.
Testing. Alright, good morning everyone. Welcome to Phillip Securities Research Weekly Market Outlook. I'm Waywen. I'll take you through the market outlook, followed by Nicholas, who will take you through our featured company for this week, which is Wilma. Right, in terms of key event risk this week, in view of key event risk this week, we advise investors to actually sit tight and prepared for elevated volatility ahead. Recall around 2 weeks ago, we mentioned that equity indices might see a meaningful pullback, and since then, markets worldwide has actually sold off, largely because of complacency when markets actually ran ahead of fundamentals. Now, looking ahead, the key thing is that complacency after euphoria could see risk assets such as equities being vulnerable to a sharp sell-off. In terms of investment action this week, we advise clients and investors to actually sit tight and be prepared for significant market volatility ahead. And pullback in equities as usual offers an attractive opportunity to accumulate our equity overweights in US, Greater China, and ASEAN economies. Now, for the Nikkei, we have actually cautioned, I think about 2 weeks ago or so, that you would likely see a downward bias. The reason for the rationale behind this is that effectively it has completed wave 1 for those who did Elliott waves. So looking ahead, the Nikkei will still continue to see a downward bias, right? Persisting amid a corrective wave 2. So let me briefly take you through. So essentially, within the broader wave 1, since 2012, the Nikkei has completed wave 1, then wave 2, wave 3, then wave 4, and wave 5. So this will form the broader wave 1. So we reckon that downward bias is likely to persist for the Nikkei as is in the corrective wave 2, right? Which could see it retracing to around 38% of its wave 1, right? For the S&P 500, on a weekly time frame, what we are seeing is that it's struggling to make higher highs. In fact, it has registered a weekly decline, right? So that does not bode well for the S&P 500. HSCI, it actually broke below the 50-day and 200-day moving average, right? And HSI also faces downward bias, right? Key support at 22.5 thousand level is broken, pierced through the 50-day moving average, right? And STI also is fallen through the 3320 key support level, and the tone would be likely to be bearish ahead for the STI. Stock Exchange of Thailand also has fallen through 1600 key support, and it did a 25 basis point rate cut last week, right? Jakarta Composite Index is resilient, it's holding above key 5000 level, but the thing is that it could be the case that the JCI has actually peaked and there could be a possible pullback, right? KLCI is consolidating, momentum is easing. Right, so in terms of what to look out for the week ahead. Now, for this week, the key major event risk will actually be the US non-farm payrolls this Friday. But before that, we have the Fed's Beige Book Assessment of the Economy on 6th June, which is on Thursday. Now, these two events will actually set the tone for equities, dollars, the US dollar, and the treasuries. So if we actually see a better than expected non-farm payrolls on Friday, what we expect is that for 10-year treasury yields to actually move above 2%, much higher, right? And that would actually be consistent with our underweight in treasuries, right? And note that tapering of large-scale asset purchases has been always contingent on the economy and specifically the labor market, and hence these two events will be of great interest this week. On Thursday, we also have the this Thursday we have the ECB meeting, right? We expect the ECB to actually maintain its key policy rate at 0.5%. We also expect the RBA, Royal Bank of Australia, to actually Reserve Bank of Australia, in its meeting tomorrow to actually stand pat, right, maintaining rates at about 2.75%. Lastly, this week we also see an informal meeting between US President Obama as well as China President Xi Jinping prior to their strategic economic dialogue. And based on past history, we tend to see a widening of the Chinese yuan trading band. So now it's around 1%. We could see it widen to 2%, closer to the key event risk on 7 to 8 June. All right. With that, I'll pass on to Nicholas, who will actually take you through our featured company for this week, which is Wilmar International.
Hi, good morning, clients. Today we'll be talking about Wilmar International. Wilmar's core net profit jumped 53% year-on-year to $314 million in first Q13. The higher earnings were primarily driven by recovery in oilseeds and grains from 1Q12 losses and higher consumer products as well as robust palm and lauric divisions. However, lower plantation earnings from weaker CPO prices offset the gains. Overall, we see this set of results as in line with our expectation, given that its contribution of 24% of our FY13 earnings estimate. Let's look at each individual segment in greater details. Palm and lauric segment. Palm and lauric margin started the year better than expected. Margin jumped quarter-on-quarter from $30 per metric ton to $30 per metric ton to $40, even though it was weaker than the $46 per metric ton in first Q12, when the full benefit of the revised export tax in Indonesia was felt. We think this may be attributed to lower CPO stock fixed cost. We believe due to its balanced spread of refining assets at an aggregate level, Wilmar is not showing any pronounced weakness from the threat of greater refining capacity over in Indonesia. As it balances that with greater margins from its Malaysia-based assets. Do take note that Wilmar is the world's largest global processor and merchandiser for palm and lauric oil. The oilseed and grain segment, contributed by both oilseed and crushing and flour milling, continue to see quarter-on-quarter recovery in margin from 10 metric tons to 10 metric tons from 9 metric tons, thanks to the lower soybean availability due to the logistic issues in Brazil. This had caused soybean meal and oil prices to temporarily strengthen as a result. We do, however, anticipate some headwinds from lower soybean meal demand in Q2 due to the ongoing bird flu, which may dampen the segment's recovery in the near term. with further downside risk if prolonged. With regards to the overcapacity issue, this has already brought Wilmar's crush margin to a structurally lower level. So what we are seeing is that what will happen next is that we see that the margins will probably normalize, given that it has already we have already seen 3 consequential quarter of positive margins. Overall, we expect this OIC division to recover back to half of its peak margin levels by FY14, as Wilmar remains the firm with the best scale in this segment to ride out the cycle. Wilmar's consumer segment continued to perform well in first Q13, thanks to the drop in soybean oil prices since December last year. Margin for consumer product division has improved slightly from $42 in first Q12 to $43 in first Q13, with volume growth of 10% year-on-year. This helped to grow profits to $57 million, up by 12% year-on-year. As shown in the figure of here, we see steady execution since the second quarter of 2011, and Wilmar's ability to ride out the volatility in raw material prices. Going forward, we believe the lower commodity price would reduce fixed stock cost, which should be favorable in its consumer products margin going forward. Sugar contribution. Over at the sugar division, as the milling season only starts in the middle of the year for Australia itself, it is common to incur losses in the first 2 quarters. However, that said, we started to see some growth from the Indonesia sugar refining businesses, which Wilmar acquired back in 2010 and 2011. Given that the government's floor price policy, it has benefited Wilmar, given their exposure in Indonesia itself. It reported a lower loss of $40 million in first Q13 versus higher losses in first Q12 at around $48 million. Due to the stronger earnings for its sugar merchandising and processing division, with better operating environment, we expect profitability to improve going forward in 2013. Plantation segment was the key weakness in first Q13. While there was a 4% year-on-year growth in FFB, lower CPO prices lead to a 27% year-on-year decline in profits. However, we note that the correlation of Wilmar's plantation profit with CPO prices is not as high. As you can see over here, the charts, despite a fall in CPO price, PBT actually increased, and we see it as and the main reason behind this is we suspect is due to trading gains by the company itself. Hence, we going forward, despite the fact that we have already forecasted a lower plantation profits due to the low CPO prices, we see potential upside may be seen if there is trading gains. So all in all, we continue to like Wilmar for its integrated business model and a strong management team. We believe that its earnings are more resilient compared to upstream plantation companies during times of lower CPO prices, given that only 23% of its FY12 PBT came from plantation segment itself. Wilmar is currently trading at slightly above minus 1 standard deviation at 12 times forward PE. our target price for Wilmar is 370, which is derived from a blended of PE and DCF valuations. We continue to reiterate our accumulated rating for Wilmar. That's all for today. Thank you. Questions? Well, our take on Wilmar itself is that we see it as a long-term growth, we see it as a long-term company in the sense that it has strong long-term sound fundamentals in terms of its integrated agriculture business model. Given the fact that it has exposure over in emerging markets in China, heavily in China, it has also expanded its operations over in Africa. It has exposure in Indonesia and as well as India itself through its associates. So in a sense, we see Wilmar as a Asia play itself. Given the fact that emerging markets is still going to be the growth driver, global growth driver in the near future. And how do you see, and this question, I assume this is also for Wilmar itself, how do you see the drop in the market will continue? Well, we see that the drop is mainly due to we suspect the drop is mainly due to the concern over in the US, given the fact that the QE concern. But we see this as an opportunity to go in because fundamentally for Wilmar there's still not much changes. Hi. With regards to P ratios, Wilmar is currently trading at, as I mentioned earlier, Wilmar is currently trading at 12 times PE. As for Nova, it's currently trading at around 14 times PE. As I mentioned earlier, Wilmar has 5 main business segments. It's palm and lauric. For its palm and lauric business, it is the world's largest supplier of palm and lauric oil, with a market share of about 30%. It is also the for consumer products. It is also the largest supplier of a consumer branded consumer oil in China itself. For its plantations segment, it is also one of the largest palm oil planters in the world. Most of their palm products are actually supplied to the palm and lauric divisions. In fact, they actually have to source for other CPOs from other upstream planters. Sugar, for the sugar business, they are the largest refiner in Australia itself. They are within the top 10 sugar supplier in the world. So all in all, we should see Wilmar as not just we shouldn't see Wilmar in the sense that if commodity price is low, then profits will be low, because Wilmar is pretty different from pure upstream players in the sense that they do refining on the raw materials, and this value add actually gives them a markup in terms of their the refined products that they actually produce, and that in a sense makes their business even more resilient in times of low commodity period.
Hi, this is Ken here. A question on the rates. The view from our department is that the current, although prices have come down quite a bit, the yields are still currently not attractive. It's more of we have a neutral call on the sector. This is primarily because a lot of the REITs are still not actively acquiring new assets.
Hi, Joshua here, Head of Research. Okay, there's a question here for the market direction. How long will this take? Well, it's very, it's going to be difficult to say how long it will be. But our general view is that corrections will tend to be shallow because we think that the second half of this year will see a rebound in economic activity. And we also think that actually, if you look at all the asset classes, actually currently stocks are the most attractive, yeah, so we actually view that corrections are a buying opportunity at this point.
Okay, with regards to Aussie price getting weaker, pushing down the price of the sugar segment. Well, for us, in a sense, it comes to the fact that Wilmar is is one of the largest sugar refiner in Australia itself. So in a sense, the weakening of the sugar price, yes, it do affects the plantation, the sugar plantation profits, but in a sense, the refining, the merchandising division will, in a sense, be supported by the fact that they actually sell their refined products over globally. In fact, selling price for Indonesia itself has the Indonesian government actually sets a price floor for their sugar products. So in a sense, this since Wilmar has exposure over in Indonesia, so they in a sense will be able to be benefit from the price floor in Indonesia. Yes, current Wilmar's PB ratio is pretty low. We see it as a good opportunity for one to hold Wilmar, in the sense that because now it's still not it's still way below the mean of 2 times PB. But having said that, we still think that the market is still concerned with the oilseed and greens division as well as the palm and lauric division, given the over capacity issue that is going to come up, especially for the palm refining business later this year. But in a sense, we still see it as not much a concern, because being one of the largest palm refiner in the world and having operations, large-scale operations in both Malaysia and Indonesia, this will enable Wilmar to neutralize the effect over in Indonesia. With regards to any changes in a consumer trend pattern and price control in edible oil in China, well, with regards to this, then again we actually mentioned earlier that the bird flu may have an impact, but this is more for the soybean meal protein product. With regards to consumer trend, we still see steady growth in China. And with regards to price control in edible oil, currently inflation in China is still under control. So in the near to medium term, we shouldn't be expecting any price control over in China itself. But having said that, management has actually mentioned during the first Q briefing that due to the fall in commodity prices, they are also adjusting the selling edible oil selling price to be able to retain their strong market share over in China.
Hi, with regard to the question of whether there's more downside risk ahead and it's not yet time to long yet, in particular reference to what we mentioned in today's morning note, right? I guess in the premise of our argument is this: this week is a very data-heavy week, right? The key major event risk could be actually the non-farm payrolls. So like what we mentioned, if non-farm payrolls come in better than expected, it'll be a boost to your treasury yields, which could actually dampen your sentiment, which could actually dampen sentiment to some extent. So whether is it time to long yet, I think there's no straight answer to it, but it could be the case that effectively what we're trying to say is that this week will be more volatile, right, in view of the data ahead. The idea is really to actually stay nimble, right? If there are pullbacks, substantial pullbacks, we should enter on our equity overweights, because after all, we still maintain our view that 2013 is still likely to be a year of equities. So I guess the idea is to actually stay nimble and then accumulate on pullbacks, right? Alright, for the next question of how long we actually see the low interest rate environment for Singapore to actually last, I guess there needs to be, I think for all of us, we know that our SIBOR, our interest rate, is very much linked to the Fed fund rates, right? So the thing is this, there's a very subtle distinction between the Fed gradually tapering its large-scale asset purchases and the Fed actually hiking rates, right? So while the Fed actually said that it will gradually taper its large-scale asset purchases, it did not really say that it will hike rates very soon, right? So our base case is that while it could actually taper, large-scale asset purchases start to taper towards the end of this year. Sorry, can you folks... Okay, you have lost audio. Alright, let's repeat the last question. The last question is whether we actually see low interest rate for our environment, how long we actually see it last. The first point we want to make is this. For Singapore, the interest rates or the SIBOR is largely linked to the Fed fund rates. And there's actually a subtle distinction between the Fed tapering its large-scale asset purchases versus the Fed actually hiking rates, right? So while the Fed actually said that you would start to taper its large-scale asset purchases as soon as possibly at the end of this year, it did not say they will hike rates pretty soon, right? So our base case is that the Fed will hike rates come closer to actually 2014, mid-2014 thereabout. So when they start to hike rates, then we could see the low interest rate environment for Singapore to actually gradually end. Till then, it will largely be still a search for you, right? And that's about it. If there are no further questions, we will end our webinar here. And thank you for listening and attending to this webinar, and we look forward to actually seeing you next Monday at the same time. Thank you.